All right, Tim, question that we have that came in on our YouTube channel, which folks aren't yet aware, we're now publishing the podcast on YouTube. We'll link to that in the show notes so you can watch the show every week as well. The question is, I've been told that a 1% fee or 1% AUM, assets under management, amounts to roughly 25% of my gains over the long term. So if my account goes up 1 million, then I pay out $250,000 in fees out of the $1 million in gains. Is this mathematically correct? Tim, what are your thoughts on this one?
Yeah, so we touched on this a bit, like fees and working with advisors back in episode 404, 5 key questions to ask before hiring a financial planner. This is a great question. And, I will say that at YFP, we're biased because this is the work we do. And we believe that most professionals making the income a pharmacist is making should be working with a trusted advisor. So, most pharmacists are going to be in that top 5% of income. If you look at, household income, and most will be even earlier in their career, even like new practitioner, they probably should be top 25%.
That's right.
With regard to net worth. So that's a question that we often get. It's like, should I have an advisor? And the answer is typically unequivocally yes. So I've seen this 25% out there with regard to fees. And we kind of ran like a similar exercise. So if you have $500,000 invested over a 20-year period with an 8% average annual rate of return, that portfolio at the end of that time period should be about $2.3 million. If you were to lower that return to 7% to account for a 1% fee, that portfolio would yield about 1.9 million. So the math is imperfect because obviously there's lots of variables here, depend on the amount saved, rates of return, the amount of the fee. Often fees are typically tiered down. So the more you invest, the lower the percentages. Right. The timeline for investing typically is not a linear in terms of how fees. So some years, you might get 12%. Some years you might be down 2%, but the 25% I say is pretty close. I think that the question that I would ask is like, what do you get for that? And the way that pharmacists' brains often work is like they want to level the scales, right? So they say, if I give you X amount of dollars in fee, like what's the ROI? What do I get back? And often the question that I ask is, how do you define a good ROI? Like, what is that? And most of the response to that is like, I don't know. There is a quantitative, I think, look at this, and there's a qualitative look. But before I get into that, Tim, one of the studies that I like to cite was performed by Vanguard back in 2021. So this is the Advisor Alpha study. And what they looked at in their study, which they have affirmed year and year again, that they believe that their math and the study is sound, is that if you take a hypothetical portfolio, it's kind of similar to what we ran. If you take a hypothetical portfolio of $500,000 over a 25-year period, they see that an advisor managed portfolio grows from about $500,000 to $3.4 million, or about 8% per year. The self-managed, or the do-it-yourselfer, that portfolio grows, but it's typically by about 5% per year, or to about just shy of 1.7 million. So the self-managed is about 50% less. So what the advisor's alpha is really 3% per year. So 8% for an advisor managed versus the self-managed of 5%. So 3%. And they feel that about a half of that is behavioral coaching. So, and this is net of fees. So they also assume a 1%. So I think the negative on what we said, or what the questioner is asking, is like they're going to assume that they're going to get a steady 7, 8, 9% per year, which we know is not correct, right? So, and I think do-it-yourselfers would say, I can definitely get there, but I think there's way too much overconfidence, and I'll talk about that a little bit. So I actually think that investment returns don't tell the full quantitative improvement or quantitative picture, Tim. So There was a study done by the Investment Funds Institute of Canada, and basically what they said is that just like investing, the value of advice compounds over time, but more on a holistic net worth perspective. So they did a study that measured net worth every 2 years between 1993 and 2008. And basically they said having a financial advisor in 1993 was significantly and positively related to subsequent net worth. The impact on net worth for advised individuals was greatest by the end of the study period, suggesting that the impact of a financial advisor grows over time, which sounds like no duh, but I think like in a microwave society where we want like results yesterday, it's really important to know that like this does take time. And what they actually measured is a control group that had no advice on the assets that they grew over time versus a group that had advice over a 7 to 14 year period. Those that were being advised on for 7 to 14 years, their assets 2x'd, right? So Vanguard does a study that says, hey, an advisor adds about 3% per year. The Investment Funds of Canada says like, yeah, you can if you're typically engaged with an advisor, you're going to 2x your investments over that amount of time. So I think the other part of this is the qualitative side of it. So, and I think this is often the overlooked component. So many of the times, like when we're working with clients, the discussion is far beyond money, right? Money is a tool. Like money is the smoke that we have to blow away, and then we get to the root cause of what we're really trying to achieve in our life. So we talk about this as like the life plan that's supported by the financial plan.
Yeah.
So one of the exercises we do is we say, hey, if we go out a year and we look back, what does success look like? 3 years out, 5 years out, 10 years out. We jump in the DeLorean, we rev it up to 88 miles an hour, and we go 30 years out. What does success look like, in June of 2055? And the further we go out from that, the less connected we are to that. But what we have found is that when you are engaged in your financial plan, the things that you thought that were a 5-year or a 10-year are things that we can get done in 3 years or 5 years. Like we see that time compress. So the qualitative questions and things that we're trying to accomplish that are less about the dollars and more about, am I living a wealthy life? Am I doing the things that I want to do? Or am I stuck on an autopilot and I'm kind of stuck in this hamster wheel? I think is the power of financial planning. And I would say the impact that we make is far greater on that side of the ledger than it is even on, is my Roth IRA, invested properly? Do I have the right insurance? Those things, those technical things that, Tim, we have to be sound and we have to make sure that we're moving the needle on that. But I think the impact and the transformation comes from things that are not even related to that. So I think whenever I get that question, to me, and a lot of it comes from people that I think come from the do-it-yourself camp. That's not our market, right? The people that are do-it-yourself, that say, hey, I don't need the behavioral coaching. You're not going to be good clients for us in terms of like the financial planning perspective. And like we have to accept that. I would argue, Tim, that there is overconfidence in that population. In many
100%.
cases, I would actually put financial planners in that bucket. As a financial planner, there's just, it's too much for you to manage objectively. And then you add the wrinkle of a spouse with different money scripts and things like that. It's just too much. And I think that we try to oversimplify. It's the same thing. Like, I'm trying to justify a financial planner. I think pharmacists do the same thing, rightfully so, right? Because of what pharmacists add in terms of value to the marketplace and healthcare and all that kind of stuff. But, I think that the overconfidence is often something that it's just hard to overcome that. So to me, I think that, when you are trying to level hey, if I give you this, I expect this in return, that's really hard to kind of get down to like the dollars and cents, because I think the impact is much greater than that. And I think there's studies to support that. If you work with an advisor, your money will go that much further. And I think the qualitative things that I think get swept under the rug, is even more important in terms of your your ability to progress and live the wealthy life that you're trying to accomplish.
Tim, I feel comfortable saying this around when we're talking about the DIY and the confidence piece, because I was that person. And actually, I feel like as my knowledge has grown in this topic, in this area, and just life experience, right, of living some of these things over the last 15, 20 years, I feel like as time goes on, you get humbled, right, along the way of
Sure.
like, oh, I've got this figured out. Like, oh, maybe not so fast. Or, hey, if Jess and I are working through an issue, like having a third party, super valuable, like to have somebody who's a mirror to help me see something maybe I'm not seeing. Or, hey, we can come up with a plan, but can I actually stick to the plan? And we're trying to balance 5, 10 things, like being able to have a sounding board, incredibly important. And this question, as it often does, I think for DIY investors, we started very narrow in the quantitative part of the financial plan, right? We talked about the investment piece and what's the return and is the ROI of the relationship, basically the question, is the ROI of the relationship better than whatever I'd be paying out? And then you started to zoom out, and I thought you articulated it really well, that it's not just about the investments, number one. Many other parts, as you say, if it has a dollar sign on it, we want to be engaged, involved in the financial plan, right? That could be a real estate purchase. That could be looking at the insurance side, the financial plan, making some of those big decisions, saving for kids' college, buying a home, right? So many different things that come into play here. And then on top of that, we're now layering on, hey, it's not just about the math, but there's this whole other side of the financial plan. And I would wholeheartedly agree with you that that is really where the rich work starts to happen, not at the expense of the quantitative piece. I think as you articulated, like that's table stakes. Like you got to be technically sound. Those things are going to get done. But it's really that balance of, hey, are we accomplishing what we need to accomplish from X's and O's while also making sure that when we get to the end of this road, we didn't kind of miss the point, along the way as well. So I love the nature of the question, because I think it gives us an opportunity to really emphasize, whether it be us or someone else, or we hope it would be us, as an opportunity to do the planning. Are we engaged in a way that is accounting for both the quantitative and the qualitative side? And one more thing I'd add to this, you mentioned with the study out of Canada, which we'll link into the show notes. What was that time frame? You said what, 7 to 14 years?
Yeah.
So this is not a short-term project. And that's another thing I've been humbled in my own financial plan. Like every season of life brings different challenges. And just when you're like, hey, I've accomplished that goal, or we've done that, or we've made that decision, life evolves. Financial planning evolves. I think about my own situation, right? Early on, it was student loan debt, getting the emergency fund set up, buying our home. Then we started a young family. We're trying to balance saving for retirement, thinking about kids' college. Now I've got kids who are in that 14 to 6-year-old range, where we're trying to figure out that balance between today and tomorrow. And guess what? In 5, 10 years, we're going to wake up and kids are going to be out of the house, adult children, and we have a whole nother set of challenges and obviously iterations of that along the way. So this is a lifelong journey. And I think that time piece, this is why we don't do one-time projects. This is why we don't do one-time financial plans. Like it is a longitudinal relationship, because as you saw with the return you quoted on the Vanguard study, what was it? Half of that 3% came from more of the behavioral side of the financial plan. So not just can we do this once, but can we stick with this for not 1 year, 3, but decades, multiple decades over the long run.
Yeah. And, again, no shade on anybody else, but I think what a lot of other advisors will do is it's very investment and insurance product focused and very light on financial planning.
Mm-hmm.
And I think that often does a disservice to a lot of clients. And I would be the first to say, if I'm paying 1% just for that, I don't know if that is a great bang for your buck. Maybe it is. But another thing that we can link in the show notes, and this was put out by Michael Kitces, is quantifying the value of financial planning advice. And it's just a table. And he basically kind of breaks out that, the different parts of the financial plan, whether it's tax, investment planning, estate, retirement planning, insurance, delegation of benefits, behavioral benefits, and kind of like the value of an advisor just from like a tax loss harvesting is anywhere from 20 basis points to 60 basis points. The behavioral gap, he says, up to 1.5%, which he's getting from the Advisor Alpha study. Insurance assets go where they should and when from an estate perspective. That's priceless. Ensuring when you can stop working, that's priceless. Eliminating financial catastrophic risk, priceless. Optimizing insurance coverage, 100 to thousands of dollars. So he kind of gives a range of like the value that it advisor. So again, I think it's hard to kind of like level that. And I get that question a lot. And again, it's a question that I would have asked. What's the
Sure.
ROI? What do
Yeah.
you provide? But I just think it's more nuanced than that. And, again, our market is not going to be, trying to convince do-it-yourselfers to like, I think it's a hard sell. Our market is going to be people that kind of, they know that this is not their area of expertise. They're willing to pay for it. They're willing to put in the time and be coached, right? And collaborate. And, the whole thing about, and I hear this a lot, it's like, I'm just looking for someone to look at my stuff and then I'm good, or like, hey, I'm good with my financial plan. Nothing's going to change over the next 3 to 5 years. The exercise I like to kind of go through, which you kind of talked about, is like, let's think back 3 to 5 years. How much has changed over these last 3 to 5 years? And we think
A
that
lot.
nothing's going to change in the next 3 to 5. We're going to coast. It's not reality. But I get it, right? Just like, it's difficult to, attract someone's attention. Everyone has, a budget of time and dollars that they can allocate towards things that they value, that they think are most important. And financial plan is not going to be at the top of everyone's list. I would argue, just like health, you have a physical every year, that this should be something that should be, prioritized, but that's not going to be the same for everybody. And I think there is going to be a lot of people that are like, hey, I got this. And, there's no shade on that either.
Yeah, and one thing perhaps we should have started here too is where, when we talk about the value, the ROI of a financial planner, quantitatively and qualitatively, we're doing that under the assumption that that is an advisor that obviously is competent, is acting in your best interest, there's transparency there, and that they're not necessarily just selling, crappy insurance or investment products you don't need.
Right.
And I am comfortable, boldly saying that because just in the last 3 weeks, we've had people reach out, multiple people reach out, that, hey, I worked with so-and-so big box, firm. I thought that I was getting financial planning for free. Doesn't exist, right? Grandma and grandpa were right. There's no free lunch. And come to find out, like, I got sold a crappy whole life insurance policy or two, and now we're trying to unwind that and look at the rest of the financial plan. So I said, I know that's out there. And as we talk about, the value of the fee and the ROI, we're doing that under the assumption, much of which we talked about, of things to look at in hiring an advisor in episode 404. Again, we'll cover that in the show notes, but really important as you're making that decision that we're clear on what we're looking for as we're looking to make a selection in the professionals that we're working with. All right, Tim, great stuff. If you have a question that you'd like us to feature on an upcoming episode of the podcast, you can send us an email, info@yourfinancialpharmacist.com. You can also record a question by going to yourfinancialpharmacist.com/ask YFP. Thanks so much for listening. Have a great rest of your week.